Risk management in trading is about controlling losses so that a series of trades does not damage your capital beyond recovery. Most traders fail not because of poor entries, but because of inconsistent position sizing, oversized losses, and lack of discipline. A solid risk framework determines how much you lose when wrong, not just how much you make when right. First, define risk per trade. This is the percentage of your account you are willing to lose on one trade. Many active traders use 0.5% to 2% per trade. If your account is $10,000 and you risk 1%, the maximum loss allowed is $100. That number controls position size, not the other way around. You calculate shares based on entry price and stop distance. For example, if your stop is 50 away and you risk $100, you take 200 shares. This prevents large emotional swings and keeps drawdowns manageable. Position sizing is the core of risk management. You should never enter a trade without knowing three numbers: entry, stop, and size. The formula is position size equals dollar risk divided by stop distance. If the stop is tighter, size increases. If wider, size decreases. This keeps every trade consistent in risk regardless of volatility. Stop losses are essential. A stop loss defines the invalidation of your trade idea. Without one, risk becomes undefined. Stops can be placed at technical levels such as support, resistance, VWAP, or recent lows. Avoid placing stops purely based on dollar amount. They should match the chart structure. However, you must still size your position to respect your maximum dollar risk. Risk to reward ratio determines whether your strategy can be profitable. If you risk $100, you should aim to make at least $150 to $300 depending on win rate. A 1-to-2 risk reward allows profitability even with only 40 to 50% accuracy. Many professional day traders focus more on asymmetric reward than high win rate. Daily loss limits protect you from emotional trading. A common rule is to stop trading after losing 2 to 3R in a day. If your risk per trade is $100, you stop after losing $200 to $300. This prevents revenge trading and preserves mental clarity. The same applies to weekly drawdown limits. Account drawdown management is often overlooked. When your account drops, your position size should shrink automatically because risk is percentage-based. This slows losses during bad periods and prevents blowing up. For example, a 20% drawdown means your risk per trade decreases accordingly. Scaling in and out must be controlled. Adding to losers increases risk beyond planned limits and is generally discouraged. Scaling out of winners is acceptable, but ensure the original stop still protects total risk. If you take partial profits, many traders move stops to break even to eliminate downside. Correlation risk matters when trading multiple positions. Taking 5 trades that all follow the same market direction is effectively one oversized trade. For example, trading multiple tech stocks while the market is moving can amplify losses. You should cap total exposure, such as no more than 3 to 5% total account risk open at once. Volatility-based adjustments improve consistency. During high volatility, widen stops but reduce size. During low volatility, tighten stops but increase size. This keeps your risk constant despite changing market conditions. Win rate and expectancy define long-term performance. Expectancy combines win rate and risk reward. A system with 40% wins and 1.3 reward is profitable. A system with 70% wins and 1.5 reward may lose money. Risk management ensures your edge actually translates into growth. Psychological discipline is part of risk management. Rules only work if followed. Common mistakes include moving stops, averaging down, oversizing after wins, and trading to recover losses. Consistency in execution is more important than finding perfect setups. A simple risk management framework: risk 1% per trade, maximum 3 trades open at once. Stop trading after 3 losses, minimum 1 per 2 risk reward. Always use technical stops, no averaging down. This structure alone dramatically improves survival and consistency. A silent stop loss means you do not place an actual stop order with your broker. Instead, you set a price alert and manually exit when that alert triggers. Traders use this approach to avoid visible stop orders, reduce stop hunts, and maintain flexibility, but it also introduces execution risk. How it works: you define your stop level exactly the same way you would normally. Instead of placing a stop market order, you set an alert at that price on platforms like TradingView, thinkorswim, or Webull. When price reaches that level, you receive a notification and manually close the trade. The main advantage is avoiding liquidity sweeps. Markets sometimes push slightly below obvious stop clusters, recent lows, VWAP support, and then reverse. With a silent stop, you can watch how price behaves at that level. If it briefly wicks through and reclaims, you may hold instead of being automatically stopped out. Another benefit is flexibility in fast-moving markets. You can adjust exits based on tape reading, volume, or reclaim signals. For example, if price breaks your stop level but immediately snaps back with strong buying, you can avoid exiting prematurely. This is especially relevant around indicators like VWAP or key intraday support. However, the biggest risk is execution delay. If price moves quickly through your stop level, your loss can exceed your planned risk. With a real stop order, you accept slippage but still have protection. With a silent stop, you rely on reaction speed, internet connection, and emotional discipline. In sudden sell-offs, losses can grow rapidly. Another risk is psychological. Without an automatic order, traders sometimes hesitate. They may rationalize holding, widen the stop, or wait for a bounce. This defeats risk management. Silent stops only work if you treat the alert as mandatory and exit immediately. Best practices for silent stops. Predefine the exact exit level before entering. Set alerts slightly above or below the stop so you can prepare. Use loud notifications, sound phone push. Keep position size slightly smaller to account for slippage. Do not use silent stops when you cannot actively monitor the trade. Avoid during major news events or high volatility. A hybrid approach is common. Some traders place a hard emergency stop further away, then use a silent stop at their intended level. This protects against catastrophic moves while still allowing flexibility. Silent stops tend to work better in controlled intraday environments, like range trading around VWAP, and worse in breakout trades where momentum can move quickly. They require discipline and fast decision-making. If consistency is the priority, many traders still prefer hard stops. Silent stops are more discretionary and situational. Position sizing determines how many shares or contracts you take so that every trade risks a controlled amount. It is the mechanical link between your stop loss and your account size. Without it, even a good strategy becomes inconsistent because losses vary too much. The core idea is fixed risk. You first choose how much of your account you will risk per trade, then calculate size from the stop distance. The basic relationship is dollar risk divided by stop distance equals position size. If your account is $20,000 and you risk 1%, your maximum loss is $200. If your stop is 40 cents away, you take 500 shares. If the stop is $1 away, you take 200 shares. The wider the stop, the smaller the size. There are several common position sizing models. Fixed fractional sizing is the most widely used. You risk a fixed percentage of your account on each trade. As your account grows, your size increases automatically. When your account declines, size decreases. This keeps drawdowns contained and compounds gains over time. Fixed dollar risk is simpler. You risk the same dollar amount on every trade regardless of account size. For example, always risking $100. This is easier psychologically, but does not scale as efficiently as percentage-based sizing. Volatility-based sizing adjusts for how much a stock moves. Highly volatile stocks require smaller size because the stop must be wider. Low volatility stocks allow larger size. Many traders use the average true range concept to estimate typical movement and then size accordingly. This prevents oversized positions in fast-moving names. Another important concept is maximum exposure. Even if each trade risks 1%, you should cap total open risk. For example, if you allow 3% total exposure, you can take 3 trades at 1% each, but not 6 trades at 0.5% if they are highly correlated. This avoids hidden concentration risk. Scaling into a position changes risk dynamically. If you enter partial size first, your initial risk is smaller. When you add, you must recalculate the average entry and ensure total risk does not exceed your limit. Many traders add only when the trade moves in their favor, not against them. Pyramiding is adding to winners. This can increase returns but must be controlled. Each add should either move the stop up or reduce risk elsewhere. Otherwise, the position becomes oversized. A common approach is to add smaller increments, such as 50%, then 25%, then 25%. Drawdown-based adjustments are useful during losing streaks. Some traders reduce risk per trade after a certain drawdown. For example, normal risk, 1%. After 5% drawdown, reduce to 0.75%. After 10% drawdown, reduce to 0.5%. This slows losses and protects capital while performance stabilizes. Win rate also influences optimal sizing. A high win rate strategy with small rewards still requires disciplined sizing because one oversized loss can erase many gains. Conversely, lower win rate strategies with large rewards rely heavily on consistent size to maintain expectancy. A practical structure many day traders use: risk 0.5 to 1% per trade, maximum 2 to 3% total open risk, reduce size during choppy markets, increase size only after consistent profits, never size based on confidence. The key principle is consistency. Position sizing should not change because a setup looks strong. Your edge comes from repeating the same risk profile across many trades. Risk to reward ratio compares how much you are willing to lose versus how much you aim to gain on a trade. It is defined before you enter the position and is based on your stop loss and profit target. If you risk $100 to make $300, your ratio is 1:3. This concept matters because profitability depends on both win rate and payoff size. The relationship between win rate and risk to reward is what determines expectancy. A trader using a 1:1 ratio must win more than 50% to be profitable. With a 1:2 ratio, you can win only 40% and still make money. With a 1:3 ratio, even a 30 to 35% win rate can work. This is why many traders focus on asymmetric setups where winners are larger than losers. How to calculate it in practice: identify entry, stop, and target. If you enter at 50, place a stop at $49.50 and target $51.50, you risk 50 to make $1.50. That is 1:3. This must be defined before entry, otherwise the ratio becomes emotional and inconsistent. Risk to reward also affects psychology. Smaller stops with larger targets require patience because many trades will not reach full profit. Larger stops with smaller targets produce higher win rates but can create larger drawdowns when losses occur. Neither is inherently better. Consistency matters more than choosing a specific ratio. Intraday traders often use different ratios depending on setup type. Breakout trades, typically 1:1 because momentum can extend. Mean reversion trades, often 1:1 to 1:2 since targets are closer. Scalping, sometimes 1:1 or slightly less, but requires high win rate. Trend continuation, 1:3 or more if trailing stops are used. Partial profit taking changes the effective ratio. For example, if you sell half at 1:1 and hold half for 1:3, the combined outcome may average around 1:2 depending on execution. Many traders use this to balance win rate and reward. Trailing stops can improve reward ratios. Instead of fixed targets, you let winners run while keeping risk fixed. If a trade initially aims for 1:2 but continues trending, the realized reward may become 1:4 or higher. This increases long-term expectancy. Common mistakes include taking profits too early. Traders often cut winners at 0.5 R but allow full 1 R losses. This reverses the intended ratio and makes profitability difficult. Another mistake is widening stops after entry, which increases risk without increasing reward. A practical guideline is to avoid trades that do not offer at least 1 or 2 potential. If the nearest resistance only gives 1:1, the setup may not justify the risk. Filtering trades this way reduces overtrading and improves overall performance. Consistency is critical. Even a strong ratio only works if applied repeatedly. Randomly mixing 1:1, 1:3, and emotional exits removes the statistical edge. Over many trades, maintaining a stable risk-to-reward structure is what produces steady equity growth.